what we've had is a contraction, a huge contraction in the money supply. First, the Fed hits the accelerator as fast as they can, puts the thing at the floorboard, and now they've put the car in reverse, and the money supply since last April has actually declined by 4.6%. So this has not happened, by the way, since 1938-39. That's the last time we've seen that kind of a contraction in the money supply. So again, using the same quantity theory of money model, Greenwood and I have projected in February, we projected that by the end of this year, inflation would be down at between 2 and 5%. Well, now the new headline inflation number just came out this week is 4%. The producer price index, by the way, is falling. That came out this week. It's only at 1%. So inflation is a story for yesterday, not today, but you wouldn't know it from reading the papers. They're still whining around about inflation and all kinds of non-monetary causes of inflation. If you read the paper, they're not talking about what I'm talking about. No one's mentioning the money supply and the fact that changes in the money supply affect ultimately, with a fairly long lag of 12 to 24 months, it starts affecting inflation. So that's the inflation picture. It's coming down, and I think will be probably on the low end of our forecast range for the end of the year. The range, remember, was 2 to 5%. It's already at 4%. I think it'll continue to nudge down and be probably closer to 2 than 5 by the time we end the year. The problem is one thing in the transmission mechanism. Remember, first thing, asset prices start changing, then economic activity starts changing, and then inflation starts changing. And real economic activity with this kind of contraction in the money supply, Rosanna, will see a recession coming probably by the first quarter of next year. And if the Fed keeps doing what it's doing, if they continue in this reversal that they're in, it could be a pretty ugly recession.